Good morning. I'm Rory Sutherland and I'm the Governor of the Kristin School Reserve Bank. These are my fellow Kristin School economists. Today we made the decision to leave the official cash rate unchanged at 1.75%. Our decision was based on the following key influences. In December of 2016, annual GDP growth was recorded at being 3.1%. Construction, tourism and a rebounding milk price are the main components of this growth, with all of these factors contributing to an increase in aggregate demand. Additionally, economic growth has seen few signs of slowing despite the disturbances from the Kaikoura earthquake late last year. At 3.1%, growth remains manageable and any changes to the OCR would cause unnecessary instability. Growth is unlikely to increase over the medium term due to the construction sector having little capacity for expansion. In the first quarter of 2017, annual CPI inflation increased to 2.2%, putting inflation centrally within the policy targets agreement and alleviating the possibilities of deflation. This increase was largely prompted by volatility in the fuel and food markets, causing cost-push inflation. However, with little change to core inflation, we forecast the CPI to decrease to 1.8% for the remainder of the year. This inflation rate is supported by food and transport consumption remaining high and offset by a falling house price, causing a reversal in the wealth effect. Lowering the OCR to prevent this housing market cooling is likely to drive inflation above the policy targets agreement. Consumer confidence took a small hit of 3.5 points during April this year. However, comparatively, this fluctuation is insignificant. Business confidence continues to indicate that firms are optimistic and willing to invest, and construction activity has reached a recent high. In 2016, the output gap was recording at being negative 0.4% of potential GDP, and is forecasted to reach 0.3% in 2017. This change suggests moderate inflationary pressures acting on the economy. As the economy already appears to be moving towards full employment, monetary policy is not required to further stimulate growth. With the government's newly proposed lower tax thresholds, household disposable income is likely to rise. Additionally, a $4 billion increase to net new capital expenditure in the form of infrastructure and student allowances demonstrates expansionary fiscal policy, increasing aggregate demand.
Recently, expectations of increased fiscal stimulus from the United States have risen. This, combined with the Federal Reserve raising interest rates with further increases forecasted, has led to increased borrowing costs on international money markets. According to the RBNZ Monetary Policy Fact Sheet, New Zealand banks are net borrowers of money from overseas, and as such, there may be increases in interest rates for domestic borrowers. Higher interest rates will lead to a leftward shift of the AD curve, leading to a decrease in the APL, shown here from P to P1. Therefore, the current situation in the United States is a possible deflationary pressure. However, due to the reliance on international rates, a change in the OCR may not be prudent, as it may not have such a great impact on the retail interest rates. Additionally, a relatively worse rate of job growth in Australia of 0.8% compared to New Zealand's 4% is fueling record migration. GDP growth has also bounced back from Q3 2016, which may lead to increased consumption of our exports. According to a report by the NZ Treasury, negative effects of Brexit will likely not be felt in the short term. However, that may change in the medium to long term. As the United Kingdom is our sixth largest export market, a depreciating pound and slowing economic growth could lead to, as a result of Brexit, may lead to lower demand for our exports, both in the goods and services sectors. This would have a deflationary impact, as shown in this diagram. At this stage, however, it would be best to wait and see the impacts Brexit will have, and a change in the OCR would not be necessary in the short or medium term. Finally, Chinese growth prospects have risen from 6.2 to 6.5%, along with industrial production growth increasing too. This growth is fueling an overall increase in growth among our top trading partners, leading to increased spending on New Zealand's exports and inflationary pressure.
Nationally, over the past year, house prices have increased by 10.3%. This contributes to inflation as house rental costs alone make up for over 9% of CPI. However, the RAIN's House Price Index, the HPI, has remained the same over the past month, which shows a cooling market. The number of houses being sold annually is also down 11%, according to data from RAIN's. This decrease in output is likely to be a direct effect of the increase in loan-to-value ratios from 20% to 40% on investment properties, which is decreasing demand. Commercial banks such as Westpac believe that this growth in house prices will continue to decrease, but it is uncertain if this will continue in the long term. As a result of the cooling market, CPI should decrease and therefore disinflation should occur. The positive correlation between wealth and consumer spending may also come into effect as relative housing wealth is starting to decrease. Consumer spending should also decrease. However, a recent study by the Reserve Bank of New Zealand has shown that the wealth effect is becoming less prevalent in New Zealand. Interest rates over the past 8 years have also gradually decreased from 9 to 5.5%, whilst personal debt to income ratios reach record highs. This increase in debt indicates more spending and therefore inflation. Although the cooling housing market is a deflationary pressure, the OCR should remain unchanged and the housing market should be watched intensively.
Net migration inflows are increasing, and as of the February 2017 year, net migration was at 71,300 according to Statistics New Zealand. As seen in the diagram, permanent and long-term arrivals are increasing, which increases consumption and investment spending, which is likely to increase aggregate demand, creating demand pull inflation. The influx of skilled migrants is likely to result in improved productive efficiency, which will increase the current relatively low productivity levels. As productivity is increased, this will lower the cost of production for firms, which will increase long-run aggregate supply, a deflationary pressure. However, due to tightening skilled migrant thresholds being introduced, the number of skilled migrants entering New Zealand may decrease, but potentially intensify the skill level, which may in turn intensify the long-run aggregate supply level. Westpac forecasts for the rate of net migration to decrease in the next few months, but will still remain positive. It would therefore be best to see the impacts first, and so a change in the OCR may not be necessary. Annual visitor arrivals for the February 2017 year increased by 11% from the previous year. According to the Ministry of Business, Innovation and Employment, in the year ending March 2016, international tourist expenditure accounted for 20.7% of New Zealand's total export earnings. Growth in tourism figures increases tourism spending, which increases consumption of goods and services, which increases aggregate demand, creating demand pull inflation. The unemployment rate is currently at 4.9%, down 0.3% from the previous year. Despite the increased populations from net migration, the unemployment rate is forecasted to continue falling. This tightening of the labour market is likely to result in wage inflation, especially in the construction sector. Wage inflation in private and public sectors have increased by 1.6% from the previous year. To compensate for this, businesses may be forced to increase their prices of goods and services, resulting in greater inflation in the economy. If only considering employment levels, the Reserve Bank should raise the OCR. However, the official decision should be considered with other inflationary and deflationary pressures as well.
As of the December 2016 quarter, trade is looking strong with a $1.6 billion current account deficit, down $420 million from September last year. This, combined with the net outflow of investments last year, has caused the TWI to drop 5 points since February. The weaker New Zealand dollar may result in an increase in imported inflation in the CPI, but the TWI is still historically strong, with the current account deficit also historically low at around 3% of GDP. The deficit was not funded by foreign loans. External debt levels actually decreased, reflecting favourable economic conditions overseas. Expansionary monetary policy will cause the New Zealand dollar to depreciate further, improving the trade balance but may result in an influx of imported inflation, which can be avoided by keeping the OCR constant and letting the trade balance stabilise with a falling exchange rate. Dairy prices are rising, making up 16% of exports. But as dairy production is a fairly inelastic commodity, falling exchange rate may have a negative effect on dairy export values. However, dairy is our largest export to China, which has tripled over the last decade and is set to increase with fresh free trade deals, making price predictions difficult. Commodity prices are expected to remain constant, with oil expected to increase around 5 to 10% to between $55 and $60 a barrel, which is expected to increase import prices. If interest rates dropped, the New Zealand dollar depreciation, dairy export values falling, and increasing import prices have the potential to push inflation above target levels. Conversely, an OCR rise would likely lead to an appreciation of the New Zealand dollar, which may increase dairy export values, but would most likely have the effect of increasing the deficit, although this would be balanced by a fall in AD. Holding the OCR until future commodity prices are realised and a better picture of the global economic situation is gained would avoid unintended consequences to inflation.
In summary, we consider the economy to be influenced by the following inflationary and deflationary pressures. When evaluating the resulting net outcome, we consider the economy to have mild inflationary pressures acting upon it. This is primarily driven by demand pull inflation. Considering this, we decided the change in the OCR would be unnecessary in the medium term, as it would cause unwanted instability, especially on housing market conditions which appear to be improving. At 1.75%, the OCR is still below the level of neutral interest rates, meaning inflationary pressures persist. Potential risks to the economy include a fall in house prices, a high New Zealand dollar, and trade restrictions from trading partners. However, at 1.75%, the OCR remains accommodative to allow potential changes. Thank you.
Great, thank you. We're going to move on to some questions now. So our first question is focused on tobacco prices. So the tax on tobacco is scheduled to increase by 10% on January the 1st every year from 2017 until 2020. How does this tax impact inflation, and how should the Reserve Bank respond?
Rory, earlier today, didn't you say that tobacco was part of CPI?
Yeah, tobacco and alcohol combined make up 7% of the CPI.
I just about the tax increases. I remember when the GST was raised back in a couple of years ago, there was sort of a provision that the Reserve Bank wasn't necessarily taken into account for inflation. I think there was something about with the 15% on all goods. I don't think that was taken as sort of a 15% inflation rise, so the OCR wasn't having. I don't know if that will be in place here necessarily, but I think it's just something.
How tobacco is part of CPI.
Yeah.
And an increase or significant increase should increase costs and increase inflation.
Yeah, well, because it's a main factor of CPI and these prices are going up, you'll likely see some inflation occurring, although they're not a significant impact. So you wouldn't see the whole CPI go up. So we see mild inflation increases.
Should mention that the tobacco is typically an inelastic good.
Yeah.
Because people get addicted.
Yeah. So because it's inelastic, you wouldn't expect consumption to fall too significantly.
As a result of the price increase, yes.
So yeah, I guess we could look at what the Reserve Bank should do to the OCR if we have an increase in inflation, which is essentially what this is, provided that there's no provision that it doesn't matter. Just thinking back to when the GST sort of came about. So I guess we can look at that. Yeah,
so we're going to see some mild inflationary pressures occur. We decided that is going to be the main effect. So as an effect on this, on setting the OCR, in response, you expect to do an increase in the OCR to obviously try and lower consumption and spending to prevent this inflation occurring. However, we've got to take into consideration many other factors.
Sort of as Christine mentioned in her thing about how you can look at one factor and that will impact the OCR, but you really have to look at the rest of the economy. So I think just a rise in taxes and tobacco probably wouldn't warrant in it in and of itself.
Especially as these rises in tobacco prices, they're over the long term, going up to 2020. It's over a relatively long time.
It is. Do we need to consider the transmission lag of monetary policy?
I guess
because it's sustained, this slow, gradual increase.
Well, that could mean that it could be effective if it's sort of 15, I don't know, if a year to
18 months.
18 months, sort of the transmission lag. If the tax increases over time, then I guess it's not too bad that there is a transmission lag.
So we get that sustained effects of the contractionary monetary policy.
Should we look at the size of the tax, because this is over 3 or 4 years, so it's
2020, 3 years.
So it's what, 30% increase in tax?
Is it a 30% increase in tax, or is it 3.3 each year? It's 10% each year.
It's 10% each year, right?
So that sort of just means how much the price is going to go up.
So we could actually see a large, well, not large, but a relatively decent effect on CPI.
Okay.
Stop wrapping it up.
So you would do an OCR rise if you wanted to counter that, but probably not.
Is there anything else?
I think that's all.
Excellent. So according to the Reserve Bank fact sheet, tobacco and consumption make up 7% of the CPI, which isn't too significant in the grand scheme of things. But as these prices are going up by quite a significant amount, 10% as you said, year on year, this would cause some inflation to occur. And this would largely be through the prices going up. Tobacco is relatively inelastic demand, as smokers find this a necessity, so that means consumption is unlikely to have significant changes, especially in the short term. But when you're making an OCR decision based on these, you need to consider many other factors in the economy, and this is far too small to base a decision on. There's also the transmission lag of monetary policy, which, as it's an indirect method, it takes approximately 18 months to come into action. As a result of this, the effect of contractionary monetary policy will be sustained over a longer period, and that should really help with the gradual increases of tobacco prices.
Thank you. In your deliberations, you did mention GST. Do you want to follow up on that thought? Do you know what the policy targets agreement says about taxes and government charges?
Mm-hmm.
Well, I'd assume since policy target agreement 1 to 3%, I think, with the provision for GST, where it didn't have to be taken into account. I assume maybe the policy target agreement doesn't apply to tax, or I'm not 100%. Like I'm saying that tax increases aren't taken into account.
That is logical because it's a general consumption tax.
So maybe that's sort of the answer. Is
So
it doesn't have any effect on the OCR.
As little effect on the OCR?
Or the policy targets agreement says that it is not to be taken into account. I'm not sure the exact wording or but I think, because I know that happened with GST, so I guess I'm assuming that'll be the same.
Yeah, so as Amar said, policy targets agreement is between 1 and 3%, and we've had GST increases in recent years up to 15%. But in the policy targets agreements, it says that they do not take GST into account because inflation would obviously occur because all the prices are going up by the same amount of that increase in GST.
Okay, thank you. Let's shift gears. Talking about construction, you noted in your presentation that construction growth was very strong. What do you think could limit construction growth, and what would be the consequences?
Christchurch rebuild?
So
we had a lot of natural disasters, and so there was an increase in demand for construction work.
Yeah.
I think it was a Westpac report I read which said that the spending was meant to go sort of, I think, until 2020 or beyond 2020 in Christchurch.
Yeah.
But I think we are seeing a slowdown. I think that report was published in 2015, and it said that around this time we would be.
So 2020 was when it was supposed to stop?
Well, sort of start cooling off
I
then.
think we're starting to see a slowdown.
Yeah, for sure. As we, more construction goes on, there's less to do.
From those events.
Yeah, and we've had a lot of growth in recent years. Our GDP growth has sort of been propped up a lot by that Christchurch, and also employment, especially in the Canterbury region.
Yeah. Do we want to have a look at how house prices are affecting construction? Because today especially we've had a significant report saying that housing prices are seriously cooling in Auckland.
It was lower since 2012, was it? I think I heard on the radio it was like the rate of growth hasn't been this low since 2012.
So with the slow rate of growth, obviously that's a disincentive for investment as prices aren't escalating as much. Would we agree with that?
I mean, we're looking at construction, so the construction of new houses. So I guess you're saying that the construction of new houses would be disincentivized slightly.
Possibly, yeah.
But I guess the question is not what is going to lead to lower construction. Was it?
Well, it's possibly not that demand is falling so much, but that those lower figures are hurting the business confidence and the confidence of that construction.
What was the question? What the impacts of the economy? What is the
of
the slowing construction?
Of limitations to growth.
My mother constructs houses for a job, for a living, and she's actually looking into moving her business elsewhere outside of Auckland as a result. So I mean, that's anecdotal evidence.
And, I mean, if we saw that on a large scale, we could see people moving out of New Zealand as a whole. So
and also supply. Well, with cooling house prices, you assume that there's some evidence that supply is catching up with demand. And once we do get to that extent where it has caught up, there'll be lesser demand for construction, surely.
So if we're looking at the impact on the economy, we can look at the macroeconomic indicators, sort of. I mean, unemployment, that especially in the Canterbury region, I think that could be quite significant, as a lot of the construction workers find themselves out of jobs there. Inflation, I mean,
got to consider these are possibly longer term. Because I feel construction in the short term is still going to be strong.
Yeah, I mean, there's still high construction activity. So, are we happy with that answer? Is there anything else?
It's not going to affect trade to a great extent.
But what other things could limit construction?
What could limit construction?
That's I think we've got that.
Christchurch rebuild. Auckland, I guess the LVR restrictions. If there's more restrictions, people purchasing less houses.
didn't apply to new built homes, did it?
Okay. No, it
Oh,
didn't.
no.
No,
Yeah,
it didn't.
you're right
Right,
there.
yeah, good point.
Right, so we had a recent Westpac report that said construction was slowing, and that was largely due to the Christchurch rebuild as a possible theory for this. And that's because as Christchurch becomes more and more complete, there is less demand for construction to happen, and that rebuild is really slowing down, and there's not as much requirement for that. There's also a slow rate of house price inflation, especially in Auckland at the moment. As Bruce said, lots of businesses are looking elsewhere. So this definitely creates less demand for investment properties in New Zealand, as they're not as profitable in the long term. And also, as the supply, with the house prices slowing, it sort of shows that supply is starting to catch up with demand. And as supply does catch up to demand, there becomes less and less need for housing, and that would slow the rate of construction nationally.
Good, thank you.
Thank you. Changing tack again. The Reserve Bank employs flexible inflation targeting when making monetary policy decisions. What does flexible inflation targeting mean, and how is it different from strict inflation targeting?
Right.
Flexible, I'm assuming, is between. It's
Right,
because
yeah.
we're setting the policy target agreement between 1% and 3%, whereas in it's the UK,
I know the UK
and
is
the
2%.
US,
They
where
try to
it's
set it at 2%.
trying to get it to 2%.
2 to 3%.
Which is good because it gives the Reserve Bank flexibility in the. Also, maybe another possible one, I'm not sure, is how the Reserve Bank sort of looking at medium-term inflation targeting. I don't know. So there can be short-term jumps in inflation or stuff. But yeah, I mean, not 100%.
And possibly slowing kind of quick reaction OCR decisions.
Just elaborate on that a bit.
Like if it, because we've got that range, we've got that kind of flexibility, to use the word, to not kind of change the OCR
Immediately.
immediately,
yeah.
and
That gives, and
looking
also
at medium to longer term.
And having that range also indicates the business confidence and consumer confidence. If it's within that range, it's okay. Or if you've got a fixed amount of 2%, people start to get a bit paranoid when you get 1% either side.
Yeah.
So that range ensures confidence.
Yeah,
Instills confidence.
so strict inflation targeting could be strictly 2%. I don't know.
Yeah.
A specific
Yeah.
number.
So
And also over that medium term, that sort of sets out where they want it to be in.
Yeah.
So very short-term fluctuations in that, like the increase we've had recently due to volatile markets, are okay because we know that in the medium term that will go back to a more suitable range.
is the question sort of what are the implications of the fact that we
What's
have
the-
flexible?
What's the difference?
What's the
from-
difference between
yeah.
strict and okay?
Cool.
I think William's idea of maybe versus the UK where it's
Yeah.
has to be 2% would
Yeah.
be a good assumption.
New Zealand's strict target, strict value wouldn't necessarily be the same as the UK, right?
Yeah. But then you want low sustained levels of inflation.
And by having flexible inflation target rates, that sort of gives us time to consider all the domestic international factors as well.
Yeah. Right, so we'll wrap that up there.
That's nice, and in your summaries you can conclude explicit reference to the policy targets agreement would be helpful.
Sorry, what was it?
Explicit reference to the policy targets agreement, which was mentioned in your deliberations,
Right.
would be helpful.
Yeah. So the Reserve Bank has a policy targets agreement of between 1 to 3% inflation in the medium term, and this differs to other nations like the UK who use a fixed inflation target, which is, I think it's set at 2%, and other nations adopt that as well. So this range really instills inflation confidence amongst consumers and businesses, as when it's within that range, you get more area for the Reserve Bank to say that monetary policy is going well, where in other economies they might get paranoid when there are smaller shifts in inflation. The policy targets agreement also said that it's over the medium term, and this allows temporary increases and decreases below the policy targets agreement. Recently we've had some very volatile inflation expectation changes due to fuel and food, but that core inflation rate will not probably adjust as much. So that medium term allows that, and the more flexible inflation targets allow it to fit into that 1 to 3%.
Okay, thank you.
Awesome. So I think we're moving on to our last question now. in a similar vein, talking about the inflation targeting framework, why does the Reserve Bank publish its forecasts for inflation and interest rates? And why might some other central banks choose not to?
Well, they would forecast them to allow businesses to prepare,
Yeah.
for one.
Yeah.
So
Yeah.
they know roughly what's coming, so they can prepare their investment plans ahead.
Yeah.
So we can look at the role of inflationary expectations in sort of stability in New Zealand and why that might be important.
Hmm.
I think it allows for greater transparency between the Reserve Bank and consumers and businesses.
Yeah, absolutely. And consumers really like that transparency because they have a lot more confidence in the economy.
Maintaining that
Yeah.
stability.
Yeah. Maintains price stability.
But I guess why some wouldn't.
Well, some wouldn't because they don't want the inflation expectations to affect inflation in the future. There was a report I read on New Zealand Herald recently that said inflation begets inflation because workers, when going for wage negotiations, then adjust their expectations for that, which then increases more inflation, and they don't want that escalating.
Yeah, so that is a problem, I guess, if people read the inflationary expectations, see that it's going to go up, and then they immediately ask their employers for it, and then it can, I guess, it could spiral.
Inflationary or deflationary spirals.
Or deflation, yeah. But I guess the forecast which the Reserve Bank publishes here allows different organisations to make predictions, which is very important, especially for investment planning. So if firms can sort of see what the rate of interest might be like in a year's time or something, I guess that could lead to increased business confidence, as you said, and possibly increased investment, which is definitely a positive for the economy.
The other thing it really does is qualitative guidance. By publishing that, the Reserve Bank is able to send out messages indirectly which affect business and consumer confidence.
Yeah.
And that has an effect on the economy as well.
Affecting the dollar, for example.
Yeah, just looking at the trade sector, by publishing and making those comments, they're able to influence the currency expectations as well, which is very important because New Zealand's obviously heavily reliant on exports.
Yeah.
Especially if there's not much room in the OCR to make too many changes.
Yeah.
I guess the qualitative guidance, as you said, is sort of a good other tool to use to sort of affect the economy.
Yeah.
And that would both be done, I guess, by the governor in his speeches, but also by the publishing of the forecasts. I assume.
Sorry, just to go off your trade point again. So it affects currency expectations as well, and that can really, and through that qualitative guidance as well, that can affect how the New Zealand dollar is going to move, perhaps whether they see it stable. Yeah.
Just like inflationary expectations affect inflation, we see currency expectations influence that.
Could the Reserve Bank, in a sense, somewhat control the market as well?
Like they can manipulate the currency market.
Well, they could, not necessarily the currency market, but they could manipulate their expectations so it adjusts to what they want.
Well, they're giving an indication of where they expect it to go.
I guess that is something which could possibly be done. I don't know if they do
trading.
I think we'll just stick with that. Is there anything else?
I think we should look at the other side, why some might not do it more.
So we've currently got to prevent the escalating spirals that happen from wage expectations wanting to increase. Is there anything else? Possibly corruption, but that's going into development.
I think those expectations are probably the main reason.
So they want to limit the spiraling effect.
They may not be confident, I guess, that people can interpret them soundly, maturely. If the workers, as I said, see expectations changing a lot, then that could, I guess it's sort of the spiraling comment.
All right, we'll go with that. So the New Zealand Reserve Bank, as you said, publishes their inflation expectations, and this allows businesses to use inflation and adjust their decisions accordingly in how inflation's going. This maintains price stability as consumers and businesses know what's going to happen, and that transparency is really helpful for consumers. They appreciate it a lot more in the government, and it instills confidence in the whole economy once you know what's happening. On the opposite side of it, why central banks wouldn't want to publish theirs is they want to prevent expectation inflation. So that occurs when people go in for wage negotiations because they see inflation's going up, they barter for higher wages as well. And this inflation, as the New Zealand Herald said, begets inflation. And they're concerned about the spiral happening with inflation and deflation as well. The Reserve Bank is also able to use qualitative guidance through publishing their reports. So they could talk up the New Zealand economy or talk down inflation expectations, and that affects consumer confidence as well, which has an effect on the economy. So that you get that added bonus of being able to influence confidence. Trade is also heavily affected by these expectations, and that allows exporters and importers to adjust accordingly.
Excellent, thank you. We're out of time, so you can now relax and enjoy the rest of the day. Well done.